Hey everyone, welcome to our channel. Today, we're diving into the exciting world of cryptocurrency trading. Whether you're a seasoned pro or just starting out, this comprehensive guide will help you understand the ins and outs of trading crypto effectively. Understanding cryptocurrency. Before we jump into the trading aspects, let's first grasp what cryptocurrency is. Cryptocurrency is a form of digital or virtual currency that uses cryptography for security. This security feature makes cryptocurrencies difficult to counterfeit or double spend. The decentralized nature of blockchain technology is a defining characteristic of cryptocurrencies. Bitcoin, Ethereum, and Litecoin are some well-known examples, each with unique features and purposes. Bitcoin, BTC, the first and most well-known cryptocurrency, often referred to as digital gold. Bitcoin operates on a decentralized network and is known for its limited supply and increasing difficulty in mining. Ethereum, ETH, known for its smart contract functionality, Ethereum allows developers to build and deploy decentralized applications, dApps, on its blockchain. It has a larger scope compared to Bitcoin, often referred to as digital oil. Litecoin, LTC, created by Charlie Lee. Litecoin is often considered the silver to Bitcoin's gold. It offers faster transaction times and a different hashing algorithm. Getting started. Now that we have a basic understanding of what cryptocurrency is, let's talk about how to start trading. The first step in trading is selecting a reputable cryptocurrency exchange, which is a platform where you can buy, sell, and trade cryptocurrencies. When choosing an exchange, consider several factors to ensure a safe and efficient trading experience. Security should be a top priority, so look for exchanges with strong security measures such as two-factor authentication, encryption, and cold storage for funds. Fees are another important consideration. Different exchanges have varying fee structures, with some charging a flat fee per trade and others taking a percentage of the transaction. Additionally, make sure the exchange supports the cryptocurrencies you wish to trade. A user-friendly interface can also enhance your trading experience by making the process more accessible and enjoyable. Lastly, check reviews and ratings from other users to gauge the exchange's reliability and reputation. Popular exchanges. After selecting an exchange, the next step is to create an account. 1. Sign up, register using your email address. Some exchanges might also ask for a phone number for additional security. 2. Verification. Complete the identity verification process if required. This usually involves providing a government-issued ID and a selfie. 3. Security setup. Enable two-factor authentication, 2FA, to add an extra layer of security to your account. Funding your account. To start trading, you'll need to deposit funds into your account, which most exchanges facilitate through various methods. These typically include bank transfers, allowing direct transfers from your bank account to the exchange, though this process may take some time. Alternatively, you can opt for credit or debit card payments, which are faster but may incur higher fees. Another option is cryptocurrency deposits, where you transfer cryptocurrencies from another wallet to your exchange wallet. Choose the method that suits you best in terms of convenience and cost-effectiveness. Understanding market basics. With funds in your account, it's time to understand some market basics before placing your first trade. One of the foundational concepts to grasp is the difference between market orders and limit orders. Market orders are straightforward. They involve buying or selling a cryptocurrency immediately at the current market price. This type of order is executed promptly, ensuring quick transactions but without control over the final trade price. In contrast, limit orders provide more control by allowing you to set a specific price at which you want to buy or sell. The trade will only be executed if the market reaches your designated price, offering potential cost savings and strategic advantages in volatile markets. Understanding bid and ask prices is also crucial. The bid price represents the highest price a buyer is willing to pay for a cryptocurrency at a given time, while the ask price is the lowest price a seller is willing to accept. The difference between these two prices is known as the spread, which can give you insights into market liquidity and potential price movements. A smaller spread generally indicates a more liquid market with higher trading volume, whereas a larger spread might suggest lower liquidity and higher volatility. Order books are another essential element of trading. An order book displays a real-time list of all buy and sell orders on an exchange, organized by price levels. This tool provides valuable insight into the supply and demand for a particular cryptocurrency. By analyzing the order book, traders can gauge market sentiment, identify support and resistance levels, and make more informed trading decisions. For instance, a large number of buy orders at a certain price might indicate a strong support level, while a large number of sell orders could suggest significant resistance. Lastly, candlestick charts are vital for visualizing price movements over specified periods. Each candlestick on the chart represents the opening, closing, high, and low prices for a particular time frame, such as 1 hour or 1 day. These charts help traders identify patterns and trends, making it easier to predict future price movements. For example, a series of candlesticks with long lower shadows might indicate a potential reversal from a downward trend, signaling a buying opportunity. Understanding these market basics equips you with the knowledge needed to make informed trading decisions and effectively navigate the complexities of the cryptocurrency market. Developing a trading strategy. To trade successfully, it's essential to develop a well-thought-out trading strategy, considering several key elements. Firstly, assess your risk tolerance to understand how much risk you can comfortably handle. This knowledge will guide decisions regarding position sizes and capital allocation for each trade. Clearly defining your investment goals is also crucial. Are you aiming for short-term gains or long-term investments? Your goals will shape your overall trading approach. Additionally, consider your preferred method of market analysis, whether it's technical analysis, fundamental analysis, or a combination of both. Finally, determine your trading frequency, whether you're inclined towards day trading, swing trading, or a more passive long-term investment strategy. These considerations form the foundation of a successful trading plan. Risk management. Cryptocurrency trading can be highly volatile and risky. Effective risk management is essential to protect your investments. Invest what you can afford to lose. Never invest money that you cannot afford to lose. This is a fundamental rule in trading. Diversify your portfolio. Spread your investments across different cryptocurrencies to reduce risk. Diversification can help mitigate losses if one cryptocurrency performs poorly. Set stop-loss orders. A stop-loss order automatically sells a cryptocurrency when its price falls to a predetermined level. This helps limit potential losses. Avoid hasty decisions. Avoid making impulsive trades based on market hype or emotions. Always stick to your trading strategy and make decisions based on careful analysis. Monitoring your trades. Once you start trading, it's essential to continuously monitor your trades and stay informed about market trends to enhance your decision-making process and optimize your outcomes. Keeping an eye on overall market trends is crucial as they play a significant role in shaping trading strategies. For instance, understanding whether the market is in a bullish phase, characterized by rising prices, or a bearish phase, marked by falling prices, can greatly influence your trading decisions. In a bull market, traders might look for opportunities to buy and hold assets to capitalize on upward price movements. Conversely, in a bear market, strategies might shift towards short selling or seeking out more stable assets to protect investments from devaluation. Staying updated with the latest news and events is equally important. The cryptocurrency market, in particular, is highly sensitive to news, with regulatory changes, technological advancements, and macroeconomic factors often causing significant price fluctuations. For example, a new regulatory policy from a major economy can either instill confidence in the market or create panic, depending on its nature. Similarly, technological innovations such as updates to blockchain protocols or new partnerships between cryptocurrency firms can drive prices up by generating optimism about future growth prospects. On the other hand, macroeconomic factors like inflation rates, interest rates, and geopolitical events can also sway market sentiments and prices. Flexibility in your trading strategy is key to long-term success. The ability to adjust your strategy based on current market conditions is what differentiates successful traders from others. This means being proactive in learning and adapting to new information and market dynamics. For example, in volatile markets, a trader might employ risk management techniques such as stop-loss orders to mitigate potential losses. In more stable markets, they might focus on long-term investments. Additionally, diversifying your portfolio can help manage risk by spreading investments across various assets rather than concentrating on a single one. This adaptability not only helps in mitigating risks, but also in capitalizing on new opportunities as they arise. Ultimately, staying informed and being flexible in your approach ensures that you are well-positioned to navigate the complexities of the trading landscape, thereby increasing your chances of achieving sustained success. That's it for our beginner's guide to crypto trading. Remember, trading cryptocurrencies requires patience, discipline, and continuous learning. Don't rush into trades, start small, and learn from your mistakes. With dedication and a well-thought-out strategy, you can become proficient in trading and uncover new financial opportunities. Thanks for watching. Don't forget to like, share, and subscribe for more tips on crypto and trading. Happy trading!